about gold saving schemes, right? Maybe your parents or grandparents have talked about them, or you've seen ads promising a smart way to build your wealth with gold. It seems like a no-brainer, a traditional safe way to get into the gold market. But here's the thing I've been thinking about. Is a gold saving scheme the best way to invest in gold? A lot of people default to this or just buying jewelry, but the reality is the world of gold investing is so much bigger and honestly, a lot more interesting than you might think. There are options out there that could be way more profitable and a lot less hassle. That's why in today's video, I'm going to smash that myth and break down not one, not two, but 10 different ways you can invest in gold. We're going to go through everything, from the old school methods you know about to some high-tech digital options you might have never even considered. I'll lay out the good, the bad, and the ugly for each one. The pros, the cons, the hidden fees, and the potential returns. By the end of this video, you're going to have a crystal clear picture of the entire gold investment landscape. My goal here is simple, to give you all the information you need so you can make an informed decision that actually works for you. Because let's be real, your financial goals, your budget, and how much risk you're comfortable with are unique. The best gold investment for me might not be the best for you. So get ready to take some notes, because we're about to dive deep into the world of gold and figure out the smartest way for you to add some of that shine to your portfolio. And make sure you stick around until the end, because the last method is the one most people get wrong. Alright, let's start with the one everyone pictures when they think of gold owning the real physical thing. We're talking gold bars, gold coins, or even those beautiful intricate pieces of jewelry. The appeal is obvious, right? There's something incredibly satisfying about holding a tangible asset in your hands. It's not just a number on a screen. It's a heavy, shiny piece of metal that has been valued for thousands of years. You can buy it from jewelers, banks, or certified dealers. The big pro here is that you have direct ownership. No third party, no counterparty risk. It's yours, and you can store it wherever you feel safest, whether that's a safe at home or a secure bank vault. However, it's not all sunshine and rainbows. The biggest downside to physical gold is the hassle and the extra costs. First, you have to worry about storage and security, which can be stressful and might even cost you money if you opt for a professional vault. Then there are the making charges on jewelry, or the premium over the spot price you pay for bars and coins. When it's time to sell, you might not get the full market price, as dealers need to make their own profit. Plus, it's not exactly liquid. You can't just sell a gold bar in 5 seconds from your phone. You have to find a buyer, verify the purity, and handle the physical transaction. It's a solid, traditional method, but it comes with its own set of very real-world problems you need to be prepared for. Now, for the one that started this whole conversation, gold saving schemes. You've likely seen these offered by your local jeweler. The concept is pretty simple. You agree to deposit a fixed amount of money every month for a specific period, say 11 or 12 months. At the end of the term, the jeweler often adds a bonus, like 1 month's installment for free. Then you can use the total accumulated amount, including the bonus, to buy gold jewelry from their store. It feels like a disciplined way to save, turning small monthly payments into a significant gold purchase down the line. It forces you to save, which is a big plus for people who find it hard to put money aside. But here's where you need to be careful, and this is a huge but. First, you're not actually buying gold each month. You're just giving money to the jeweler. The value of your investment is locked to that specific jeweler, so you can't just take your money and buy from somewhere else that might have better designs or lower making charges. Second, these schemes are largely unregulated, which is a major red flag. If the jeweler goes out of business, your money could be gone forever. There's a significant counterparty risk. And finally, you're usually forced to buy jewelry, which comes with high making charges that can eat into or completely wipe out the bonus they offered you in the first place. It's more of a jewelry purchasing plan than a pure investment. Okay, what if you want the benefits of gold's price movements without the headache of storing and securing physical bars? Enter gold exchange traded funds, or ETFs. This is where investing in gold starts to feel a lot more modern. A gold ETF is basically a fund that invests in gold bullion and is traded on the stock exchange, just like a regular stock. When you buy a unit of a gold ETF, You're buying gold in a paper, or more accurately, a dematerialized electronic form. Each unit of the ETF represents a certain amount of physical gold, say 1 gram or half a gram, which is held by the fund in secure vaults. The advantages here are massive. First, it's incredibly convenient. You can buy and sell gold ETFs through your regular stock brokerage account with just a few clicks. The pricing is transparent, tracking the real-time price of gold very closely, and the costs are super low compared to physical gold. No storage fees for you, no insurance costs, and no high premiums. It's an extremely liquid investment. The only real downside is that you don't own the physical gold yourself. You can't go to the fund and ask for your gold bar. You own shares in a fund that owns the gold. For most investors who are just looking for price exposure, this is a perfect trade-off, offering almost all the pros with very few of the cons. Now, this next one is really unique and for many people, might just be the single best way to invest in gold, especially if you're in a country like India that offers them. I'm talking about sovereign gold bonds, or SGBs. These are government-backed securities that are denominated in grams of gold. So, when you invest, you're not buying a piece of paper that says, I owe you gold. You're buying a bond issued by the country's central bank. You pay the issue price in cash, and the bonds are redeemed in cash at maturity, based on the gold price at that time. It's a way to invest in gold without holding it physically, similar to an ETF. But here's the killer feature that sets SGBs apart from everything else. Not only do you get the benefit of any appreciation in the price of gold, but the government also pays you a fixed interest rate on your initial investment every year. Right now, that's 2.5% per annum. You're getting paid to hold gold. Plus, if you hold the bonds until maturity, which is typically 8 years, any capital gains you make are completely tax-free. That is a massive advantage. The downsides? They have a lock-in period, although you can sell them on the stock exchange after a few years. And they are issued in tranches, so you can't just buy them any day you want. You have to wait for the government to open a new issue. Let's talk about one of the newest and most flexible ways to get into the game, digital gold. This has become super popular thanks to fintech apps and platforms that have made buying gold as easy as ordering food online. Essentially, you can buy, sell, and accumulate 24-karat gold online for as little as 1 rupee or $1. These platforms, often in partnership with gold refiners like MMTC PAMP, buy physical gold on your behalf and store it in insured, secure vaults. You get a digital receipt for your holding, which you can track in real time on the app. The biggest pro is the sheer convenience and accessibility. You can start with a tiny amount, making it perfect for beginners or people who want to save systematically. You can buy or sell 24/7, instantly, right from your smartphone. Some platforms even offer the option to have your accumulated gold delivered to your doorstep in the form of coins or bars once it reaches a certain weight. The primary drawback is that, like gold saving schemes, this space can have some unregulated players, so it's crucial to use a reputable, well-known platform. Also, there's usually a small spread between the buy and sell price, which is how the platform makes money, and there might be storage fees, though they're often waived for the first few years. If you like the idea of investing through the stock market but want a slightly different approach than an ETF, you can look into gold mutual funds. These are professionally managed funds that primarily invest their assets in, you guessed it, gold. But here's the distinction. They don't always invest directly in gold. Instead, a gold mutual fund typically invests in the units of a gold ETF, so it's essentially a fund of a fund. You give your money to the mutual fund manager, and they use it to buy units of a gold ETF on your behalf. So why would you do this instead of just buying the ETF directly? The main reason is for the convenience of systematic investing. Mutual funds are famous for their systematic investment plans, or SIPs, which allow you to invest a fixed amount automatically every month. While you can do this with ETFs too, it's often more straightforward and easier to set up through a mutual fund platform. The downside is that they have an extra layer of fees. You'll be paying the expense ratio of the mutual fund itself on top of the expense ratio of the underlying gold ETF that it invests in. It's a small difference, but over the long term, those fees can add up. It's a trade-off between convenience and cost. Now we're moving into the more more advanced and speculative side of gold investing. Instead of investing in gold itself, you can invest in the companies that get it out of the ground gold mining stocks. When you buy shares in a company like DuPont or Barrick Gold, you're betting on that company's ability to mine and sell gold profitably. The potential for returns here can be huge, way bigger than the returns from gold itself. A well-run mining company can increase its production, discover new reserves, or improve its efficiency, causing its stock price to skyrocket, even if the price of gold only moves up a little. This is what's known as leverage to the gold price. However, that leverage cuts both ways, and this is where the massive risk comes in. You're not just exposed to the price of gold, you're exposed to a whole host of other risks. The company could face operational issues like a mine collapse, political instability in the country where it operates, rising labor or energy costs, or just plain bad management. Any of these problems could cause the stock price to plummet, even if the price of gold is going up. This is an investment for people who have a high risk appetite and are willing to do the deep research required to pick a winning company. It's not a direct play on gold, it's a bet on a business. Alright, let's crank up the complexity and risk to the maximum level with gold futures and options. This is not for the faint of heart, and I'll be blunt, it's not for most investors. This is the domain of professional traders and sophisticated speculators. A gold futures contract is an agreement to buy or sell a specific amount of gold at a predetermined price on a future date. You're essentially betting on the future direction of gold prices. Options give you the right, but not the obligation, to buy or sell gold at a certain price before a certain date. The main reason traders use futures and options is leverage. You can control a very large amount of gold with a relatively small amount of capital, which can lead to enormous profits if you guess the direction right. If the price moves just a little bit in your favor, you can make a massive return on your investment. However, if it moves against you, you can lose your entire investment and potentially even more than you started with, especially with futures. This is extremely high risk, requires a deep understanding of the markets, and involves constant monitoring. For 99% of people watching this, my advice is to admire it from a distance and stick to the other methods we've discussed. Let's bring the risk level back down to something more manageable. Gold accumulation plans, or GAPs, are quite similar to digital gold, but are often structured slightly differently, sometimes offered by banks or specialized companies. The core idea is the same, to allow you to buy small amounts of gold periodically to build up your holding over time. You can set up a plan to automatically purchase a certain value of gold, say $50 or 1,000 rupees, every month. The platform then buys the corresponding amount of 24-karat gold at the day's market price and credits it to your account. These plans are fantastic for instilling a disciplined saving habit. By dollar cost averaging, you buy more gold when prices are low and less when they are high, which can smooth out your average purchase price over time. It's a set it and forget it approach that's perfect for long-term savers who don't want to time the market. Like digital gold, your holdings are usually stored in insured vaults, and you often have the option for physical delivery. The potential downsides are also similar. You need to choose a trustworthy provider, be aware of the buy-sell spread, and check for any storage or management fees that might apply to the plan. It's a great low-stress option for steady accumulation. And finally, let's circle back to the most traditional and common way people own gold jewelry. For many, this is the default method. You buy a necklace, a ring, or a set of bangles, and you get to enjoy wearing your investment. It has a dual purpose. It's a beautiful accessory and a store of value. This emotional connection is something you just don't get from a stock certificate or a number on a screen. It's an asset that can be passed down through generations, carrying sentimental value far beyond its market price. However, as a pure investment, jewelry is probably the least efficient option on this entire list. The reason comes down to one major thing: making charges. These charges, which cover the cost of designing and crafting the piece, can range from 10% to over 25% of the gold's value. When you go to sell the jewelry, you almost never get this money back. The buyer will only pay you for the net weight and purity of the melted down gold. On top of that, the gold used might not be 24-karat pure gold. It's often 22-karat or 18-karat to make it more durable. So, if you're buying gold with the primary primary goal of financial returns. Buying jewelry is a really tough way to do it. Think of it as a beautiful purchase that happens to hold some value, rather than a strategic investment. So there you have it. 10 completely different ways to add the stability and shine of gold to your investment portfolio. As you can see, the answer to what's the best way to invest in gold isn't so simple. There are many ways to invest in gold, each with its own pros and cons. From the tangible satisfaction of holding a gold bar in your hand to the high-tech convenience of buying digital gold with a single tap on your phone, the right choice really depends on what you're trying to achieve. It's a spectrum from pure hassle-free financial exposure with ETFs and SGBs to the high-risk, high-reward world of mining stocks and futures. The key takeaway is that you need to be honest with yourself about your goals. Are you looking for a long-term, safe haven asset to protect your wealth? Sovereign gold bonds or gold ETFs might be your best bet. Are you saving up for a specific purchase like a wedding and want the discipline of a monthly plan? Maybe a reputable gold accumulation plan is the way to go. Or are you an experienced investor with a high-risk appetite looking for explosive returns? Then maybe, just maybe, you might look into mining stocks after doing a ton of research. Your financial journey is personal. Ultimately, the power is in your hands now that you have the information. Sovereign gold bonds or gold ETFs might be your best bet. Are you saving up for a specific purchase like a wedding and want the discipline of a monthly plan? Maybe a reputable gold accumulation plan is the way to go. Or are you an experienced investor with a high-risk appetite looking for explosive returns? Then maybe, just maybe, you might look into mining stocks after doing a ton of research. Your financial journey is personal. Ultimately, the power is in your hands now that you have the information. Don't just default to what's traditional or what your parents did. Analyze your own financial situation, your risk appetite, and what you want your money to do for you. Choose the method that aligns perfectly with your personal strategy. I'm really curious to know what you think. Let us know in the comments which gold investment method you prefer, or if you're already using one of these. And of course, if you got any value out of this video, you know what to do. Smash that like button and subscribe for more deep dives into making your money work for you. Thanks for watching, and I'll see you in the next video.